We're now joined by Imtiaz Suliman from Vunani Sentio Fund Managers. Imtiaz, thanks so much for your time today. A shaky start to the week, even as bets for a Fed rate cut continue to climb. What's going on? Are markets just taking a healthy pullback, a healthy breather? Is it something to worry about?
Hi, Caroline. I think what we're seeing today is a bit of a reversal from Friday's run, especially in some of the gold counters. With the gold price being a bit weaker today, we've seen the likes of Gold Fields, Anglo Gold, Harmony, all down between 2 and 4%. And then you've also got Naspers and Prosus, which were also down 2%. And this is on the back of some of the weaker news out of China. And since Naspers and Prosus have reported their results, we've seen that discount to Tencent continue to widen as they signaled that the share buybacks would be less than what they have been doing in the past. So those big counters, as well as the gold counters, being a bit of a drag on the market, with some of the domestics like a SPA and ABSA ending in positive territory.
And that, segues us nicely into our next question, that being SPA and company news. The grocer out with full year numbers. Financials aren't great, but it is getting its balance sheet in order, reducing debt and making headway with those disposals. Were these numbers enough to convince investors that the group is on the right track?
With SPA, it all depends on how fast they can get the South African operating margin to the 3% level. And that's been the big challenge. So we had the hiccup with regards to the SAP implementation, especially at the KZN distribution warehouse, which cost them quite a bit in terms of sales. And that loyalty, whereby the retailers purchase goods from the SPA warehouse, hasn't come back as fast enough. And that's still taking time. So although we've seen some improvement at the KZN DC, it's not enough to offset the lost sales that we saw in the past. And on the back of that, we've seen their margin being impacted. And that's now sitting below 2%. So they've got a bit of a plan to get to 3%, which will take some time. And if they do get to that 3%, I think that is where the upside lies. But we've seen, some of the impairments come through with regards to the Swiss operation, with regards to the UK operation, as well as some of the corporate stores in South Africa, whereby, you had a massive impairment of over 5 billion come through. So the balance sheet is looking a bit cleaner with regards to the goodwill. But nonetheless, now it comes down to increasing that margin and getting the sales and top line to grow. And with inflation coming down, not just for SPA, but you speak to the likes of ShopRite, Pick n Pay, they have all signaled that food inflation has come down quite significantly. And for a retailer, that's a drag on their top line.
And I can imagine, because that industry is also really competitive. So you are dealing with, lower selling price inflation, and you're also dealing with a consumer that really is hunting for a bargain. So they would naturally shop down. But let's move over to another company that's also been on a bit of a streamlining effort, not even a bit, a lot when it comes to Nampak, when it comes to disposing of all its non-core assets. That turnaround strategy does seem to be bearing fruit, also benefiting from a COVID-19 claim over the last operating period. Headline earnings on that front more than tripled. Your analysis on that performance, Imtiaz, even as we look at a business that's more leaner and meaner as we prepare for full Roos exit.
Yeah, I think the standout performance in Nampak's results was the Angolan operation, which certainly came through quite strongly. And we saw EBITDA grow by 30%. So although Africa has been quite challenged for a number of South African companies in the past, there's a bit of a tailwind with regards to higher commodity prices, a weaker dollar, and more stable currencies. that are helping a lot of the operations that South African companies are exposed to in the rest of Africa. And we've certainly seen that come through for Nampak in Angola. If we focus just on South Africa, we look at the beverage side and the BevCan business. There we saw a turnaround. They had some one-off disruptions at the beginning of the year, and that hasn't repeated. So we've seen a steady improvement from that perspective. But from the consumer side of the business, with regards to the infant milk formula, there's been a shift out of metal tins. There's been lower demand for some of the canned products, and also from aerosol sprays. So I think from a consumer demand perspective, in the diversifieds business, that's a bit challenged, and that will take some time to recover. And it's also very dependent on the consumer recovering in South Africa.
All right, let's get your stock pick. Where are you seeing opportunity at the moment?
Yeah, so I'm going with a property company today, Vukile. I think Vukile has quite a nice diversified exposure across South Africa, as well as Spain and Portugal. And they are squarely focused on the retail segment. They are seeing positive reversions come through. That means when tenants are renewing their leases, we've seen an uplift in those leases. And there's a good growth pipeline for Vukile because their trading densities are doing well, which means that positive reversions can continue. They also do quite strategic acquisitions every now and then, and they have a strong balance sheet to do that. So if you're putting all of that together, they're trading at a dividend yield of 7%, which is not as high as some of the other property counters, but I think the growth that's going to come out of Vukile will be quite significant, and the capital growth with the dividend yield will give you a decent return over the next year and a bit.
Right, let's leave it there. Imtiaz, thanks so much for your time and taking us through the trading day that was. Now that was Imtiaz Suliman from Vunani Sentio Fund Managers.